Hey everyone, in this video I'm going to answer which one I think is a better dividend stock to buy for passive income investors, AT&T stock or Raytheon Corporation RTX stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I'm going to compare these two across several important financial metrics, starting with the dividend yield. So let's get started with comparing these two on their dividend yield. AT&T stock offers passive income investors a dividend yield of 6.41%, a robust yield to be sure. RTX Corp offering a 4.21% dividend yield, which is also not too bad. Remember, when you're investing in dividend stocks, you're interested in the total return, not just the dividend yield, because you can buy a stock for the dividend yield, but then the stock price falls so much, it takes away all of the yield that you earned through dividends. So it's important to look beyond the dividend yield. So let's do just that. So one of the other metrics that I like to look at when I'm looking at dividend stocks is the ratio of earnings per share and dividends per share, and how has that played out over time. So what I have here is a chart of earnings per share in the purple for RTX and AT&T on the bottom here, RTX on the top, and dividend per share in the orange. And what you'll notice is, for the most part, for RTX, earnings per share has been above dividends per share. That's a good sign, because a company can only pay dividends per share in the long term sustainably through earnings per share. Now, in the short term, it can pay dividends from savings, it can pay dividends from borrowings, and so sustain the dividend in the short term even when earnings per share are below dividends per share, as has happened a couple of times for RTX and AT&T. But over long periods of time, 10, 20, 30 years, a company needs to sustain dividends through earnings. And so looking at this, both AT&T and RTX, their dividends look sustainable because they generate sufficient earnings per share to support the dividend per share, with neither of them showing considerably better performance in this metric. But I would say RTX has been better before 2019, and then after 2022 or after 2020, it looks like AT&T is slightly better. But no clear winner here in this metric between these two. The next thing I like to look at is revenue, trailing 12-month revenue, and this shows me where the company's prospects are in terms of growth, or is it in a declining category. And in these two, RTX has the better revenue growth prospects. It generated $67 billion in revenue in the most recent trailing 12 months, and it operates in the defense and aerospace industry that's experiencing a growth in spending right now because of all of the conflicts around the world. Meanwhile, AT&T revenue of 121 billion, this big decline was because of a divestiture of many of its businesses. So it's not indicative of the company's declining revenue. That being said, AT&T cannot be realistically expected to grow revenue at any meaningful sum over the next decade. The company, telecom, television, the industries that it operates in, internet, they're not going to be growing all that quickly. But at the same time, they're not going to be declining all that quickly either, even during a recession, because one of the last things people cancel during a recession is their cell phone plan, is their broadband internet. And so for those reasons, I would say AT&T will be more stable in revenue compared to RTX, but RTX will have better revenue growth prospects longer term. The next thing I wanted to look at is total long-term assets, and I see this as a proxy for the assets that the companies use to generate revenue and profitability. All else being equal, I like a company to generate more revenue and profit from fewer assets, because that shows that they can grow more without needing to invest in assets. It also shows that the cash flow that comes in can be given to shareholders without needing to be reinvested in upgrading and maintaining assets, right? If a company has a lot of assets, like AT&T does here with 371 billion in assets, that continuously needs to be upgraded, and that's going to be billions of dollars that needs to be reallocated to upgrading these facilities. And every few years or every cycle, AT&T needs to upgrade in that next technology, right? They recently did that with the 5G technology. Few years from now, 5, 6, 7, I don't know how many, but a few years from now, the next best thing will come out where AT&T will need to invest in upgrading their technology. Or if something new doesn't come out, maybe they need to spend in maintaining those investments they already made. RTX, meanwhile, has total long-term assets of 115 billion, nearly less than 1/3 of the total long-term assets of AT&T. So another important thing I look at is the operating profit margin for a company. This shows me how good they are at turning revenue into profits, right? Revenue is not impressive if you can't turn that into profitability. I cover a lot of companies that are growing revenue very quickly, but they're losing a lot of money on the bottom line. To me, that's not impressive, because it's easy to make a product that costs you $100 to make, and you go out and you sell it for $50, right? You can generate sales like that because people will look at your product and say, man, this is a great value and I'm buying it for only $50, but that's causing your company massive losses. That's not sustainable. I'm not impressed with that. I try to stay away from companies like that. But these two are generating profits consistently. Although I will say AT&T is more impressive here, not only because its operating profit margin of 20% is better than the 4.51% of RTX, but AT&T has been steadily improving its operating profit margin while RTX is going in the wrong direction. So in this metric, AT&T is the clear winner according to operating profit margin. So long-term debt is another important consideration when looking at dividend stocks, and AT&T has a massive load of long-term debt of $138 billion, and that's been rising, although AT&T has spent a good time bringing down this long-term debt, and management said that other than paying dividends, they're going to be using their cash to pay down this debt because interest rates are much higher than when they took out most of this debt to begin with. So management is aware of this massive debt load. They're working to bring it down. RTX, not really a problem with debt, just 35 billion in debt, and compared to AT&T, RTX debt looks small. And so cash flow from operations becomes that much more important when you have a company that has over $100 billion in debt. Thankfully, AT&T generated $37 billion in cash flow from operations in the trailing 12 month, and over the last decade, AT&T has consistently delivered cash flow from operations at or above $30 billion. So the company generates billions in cash flow consistently. That's good news. Same thing with RTX. Although RTX is at a smaller scale, generating around $8 billion in cash flow from operations. Remember, the company had an asset base of less than 1/3 of that of AT&T. So it's understandable that it generates fewer cash flow from operations. It's a smaller company overall when measuring under total long-term assets. Still, it's good that it generated $8 billion in cash flow from operations. It's been relatively flat over the last decade. No real growth here from RTX, and only small growth, minor growth from AT&T in the last decade in terms of cash flow from operations. And finally, I wanted to compare these two on valuation. I wanted to see how expensive these stocks are, because even if a company is more impressive than another company, if the price reflects that and then some, I would still not prefer that company, right? It matters what you pay, right? You can look at a luxury car and say, oh my goodness, this is so much nicer than a Honda Accord, but you still might not want to buy that luxury car if it costs $150,000, where you can get a Honda Accord for $25,000, right? Is it good enough to warrant that big premium? And in this case, what we have is RTX is trading at a price to earnings forward of 15.27. It's more than twice as expensive as AT&T with the forward price to earnings of 6.927. While RTX was better than AT&T in a couple of metrics, overall I didn't see a clear advantage from RTX over AT&T. certainly not enough so to warrant a more than 2x valuation premium over AT&T. So if I was a dividend stock investor choosing between RTX and AT&T, I would pick AT&T as the better dividend stock to buy. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.